Welcome to this, I guess, edition of our Louisville Real Estate Investor Meetup Group. We started this back in March of 2019, and ever since it's kind of blown up, and we've been able to have some great speakers like yourselves on the meetup, and we're just really excited to host you. Luke, do you have anything you'd like to add to that?
I think you got it covered there, Raphael, but I know I just filed my taxes, after my extension and everything. And so I think it's perfect time to talk about taxes, and excited to hear what you guys have to say. So appreciate y'all coming on. Thank you so much for your time.
Yeah, thank you for having us.
So I'm going to go ahead and let you guys share, but in the meantime, I just want to let you guys know, for those of you who don't know, Amanda and her husband run a tax agency in California, and they've written a book with Biggerpockets. It's a phenomenal book, by the way. I actually have it in my library, which I got a chance to read it a few months ago. So definitely great job on that. And yeah, I mean, kind of take it away if you guys want to kind of give us a quick bio of yourselves and everything.
Sure. Do you want to start?
Sure. Yeah, I'm Matt MacFarland. This is my wife and business partner, Amanda Han. We have a tax practice here in Southern California. We've got both over 20 years of experience. We kind of started in the Big Four accounting world, if you will, and the years that we worked there, we kind of worked with small, medium-sized businesses, wealthy individuals, athletes, that kind of thing. And so when we decided to start our own practice, one of the things we had worked on was also real estate investors. And so that's kind of what we understand and what we know. And so I'd say probably 80-90% of our clients are real estate investors to some extent, whether it's, working a W-2 job, investing on the side, or we've got, it kind of runs the gamut to the people that invest full-time, doing fix and flips or syndications or just, portfolios of long-term holds, all that kind of stuff. So it's what we know and what we understand, what we like. So, yeah.
We're investors ourselves. So, it's always interesting for us to meet people like you and see what everyone else is doing in real estate. And we do have clients all over the US. Like Matt said, specifically, people come to us for real estate strategy. So we're really excited to be here tonight. I think we put together a brief presentation. That portion should maybe take about 15-20 minutes if we're quick. And then we want to leave the rest of the time for Q&A, because I think you guys probably have quite a few questions from, just filing your tax returns, like Luke said, or things from the CARES Act, and of course, maybe the upcoming election. So let's get started. Can you guys see the screen right now? Everybody can see it?
Yeah, I can see it.
Okay, perfect. So one of the things we want to start with is, one of the questions like, why do tax planning? Why are we talking about taxes? Because tax return deadline was just over, right? And this is an interesting statement from the Tax Policy Center, where they talked about this concept that people with the same amount of income may pay very different total taxes. And what they mean by that is, if you take two different individuals who, maybe each make $100,000 worth of income, one might be paying a somewhat high tax rate and another might be paying zero tax rate. And on the face of it, that seems maybe, sort of strange as to how that could happen, because clearly we have, the set tax rate in the US. But the easiest way to think about it from using real estate as an example, if you're someone who makes $100,000 in W-2 income, odds are you are paying a decent amount of taxes on that money through income taxes as well as payroll taxes. And there's oftentimes not a huge amount of deductions that you can use to write off against the income. But let's take another person, maybe it's you, maybe it's a neighbor who makes $100,000 worth of rental income. Oftentimes that person might pay very little or maybe zero taxes on the rental income that they receive. So 100,000 of income, W-2 versus rental, one might be paying high taxes, one might be paying, low to zero taxes. And that's kind of how the tax code is written. So, these are some of the concepts that we want to talk about tonight. What are those things? What are the differences, and what kind of strategies can we use as investors to have essentially tax efficient or tax-free income from our investment properties?
And so you see on the screen here, this is just a quick view of what the 2020 tax rates are. We like this one because it's kind of color coded. So, down the left side, if you're single, you would look at the income ranges there. Down the right side, if you're married, you can look at those. A couple takeaways here. You see the highest federal tax rate is 37%. It's down from 39.6 it was like 2 or 3 years ago. We still have, graduated tax scales, obviously, so not all of your income is taxed at 32%, for example. The other takeaway here is we've got some capital gains rates too at the bottom. So if you have capital gains income, sometimes, some of them might be taxed at 0%, some at 15 or 20%. Those are kind of the big takeaways. There's still 7 brackets, as you can see. That was kind of more or less the same a couple years ago.
Yeah, and the key thing, I think one of the biggest errors or mistakes that we see when we talk to investors all over the US or look at tax returns all over the US, I think one of the biggest mistakes that we see are investors not taking advantage of tax deductions. So oftentimes you hear people talk about, oh, if you're a business owner, you get a lot of tax write-offs. You can write off your car and your cell phone and all these things. And it's important to understand that as a real estate investor, you are essentially a business owner in the eyes of the IRS, right? You are in the business of real estate investing, whether it's rentals, whether it's being a realtor or wholesale fix and flip. So you are in the business of real estate. So we're going to go over some common tax deductions that are available to investors because you are in the business of real estate when it comes to taxes. Okay, so we'll go to the first one, which is home office deduction. This is a really simple one that I think, most, if not all, real estate investors would be claiming, especially in times like today where there's COVID.
Yeah, but even having said that, it's actually probably one of the most overlooked deductions that we see for real estate investors and business owners, just because so many people are using it. But a couple of the reasons why it's overlooked, I think, is one, a lot of people still think it's a red flag audit item for whatever reason. This came out 20 plus years ago. Probably was a red flag item at that point in time, obviously, when it was brand new. But there was a study even pre-COVID. A couple of years ago, I read something like 50% of Americans have some sort of home-based business. So obviously, if you think about it from like that perspective, they're doing some work from home. So the idea is with the home office deduction, if you have a dedicated space at home that qualifies as a home office, don't be afraid to take the home office deduction. The goal here is that, obviously real estate investors like yourself, you understand that you got a primary residence, you're deducting mortgage interest and, some or all of your property taxes. But the idea with the home office deduction is, can we convert some of those other things you're paying for your house and turn them into business deductions, like a portion of the insurance, utilities, repairs, cleaning, HOA fees, those kind of things that are typically non-deductible personal items. But now with a qualified home office, you can take a percentage of that and take it as a business deduction.
Yeah, I think some common misconceptions on the home office, like Matt said, one of the biggest ones is, is it a red flag? And it really hasn't been for many, many years. So if you're a CPA, someone who's still telling you it's a red flag, I would challenge them on that. The IRS has actually made it easier for all of us to claim home office with a standard method of tax write-off. The home office is available even if you have another office that you work from. Obviously today a lot of us are just working from home because of COVID, but outside of that, if you have, let's say if you're a realtor and you have another office where you work out from the broker's office, that doesn't mean you can't also have a home office if you have a space in your home where you are performing your tasks as a realtor or as a landlord, managing your properties. And in fact, for our clients that are landlords, I think we probably have very few, if any of them, actually rent an office space to manage rental properties, right? Most landlords manage the properties from their home office. So if you have one, certainly make sure that you take advantage of it. One of the requirements for the home office, though, is that it is dedicated or used exclusively for your real estate. And what does that mean? That just means that your home office cannot also be a nursery for your kids or a guest bedroom for friends when they come over. It can't be part of, it can't be like on your dining room table because that's where you also are eating from. But the home office doesn't have to be a separately enclosed room. So you can see like on the picture here, this is the end of a hallway on the left-hand side. So that space is used only for, office work. So that could be a legitimate office, even though it's not a separately enclosed room. Okay. And then I think the only other thing I want to mention is for home office, there's a misconception that you can only take that write-off if you own your home, and that's not true at all. So even if you're renting for your primary home, you can still certainly take advantage of the home office. The only difference is, if you own your home, you're deducting part of the interest and taxes. But if you're renting your primary home, you get to deduct a portion of that rent expense. So that's fairly significant, especially since, rent expenses usually are not tax deductible when you're renting your primary. Okay. So let's go over another strategy that is really powerful for a lot of real estate investor clients of ours, and that's the concept of income shift.
Yeah, I think one of the questions we get a lot is, how do I write off or can I write off my kids? And obviously, just thinking of it from that perspective, the answer is generally going to, you ask your CPA or tax preparer that question, the answer is going to be no. But the right way to look at it is, how can I do it right? How can I implement the kids or even another family member into your business, have them help you in your business and pay them for the work that they're doing. That way you as a family can get a tax deduction for the money that you're probably already giving the kids anyway, right? I mean, especially if those of you have teenagers, I mean, we know teenagers can be expensive. So they're going out with their friends, they want to go get food, they want to go to movies, whatever it is, they want to, money for cars or, so this is a way that you can hire them, help you in your business, pay them some money. You're getting a tax deduction. I guess if you think about it, like, if we showed you those rates, but if you're at the 35% bracket and you pay your kids $10,000 to help you in the business, that's a $3,500 tax savings, right, for you. And then as the kids, actually each person can now make up to $12,000 and not have to pay any income taxes on that. So that can be a win-win for the family.
Yeah. We'll open it up for Q&A after the presentation part, but I know I'll just preemptively let you guys know a couple of common questions we get on income shifting. One is, how old do the kids have to be? So there's actually no age requirement for income shifting from a tax perspective. The IRS does require that the payment amount, the compensation, is reasonable for their age and the kind of tasks that they can perform for you. So, our 9-year-old is not going to be the IT director for us by any means, but they could maybe help out with little data entry stuff here and there. In fact, now with working from home and seeing kind of the distance learning, I would say, our older son probably knows a lot more about Zoom technology than Matt or I. Sometimes we bring him in to say, where are the chats coming in? How do I mute things? So it does have to be reasonable. Basically how much you pay your kids should be the same amount you're paying someone else's kid, or just someone else that you're hiring to do the task. And so naturally, that just means the older your kids are, the easier it is to shift a larger amount of money to them, because when they're teen or preteens, then they can do a little bit more substantial work versus, some of them that are at younger age. Okay. And we do have clients who have older kids who've even graduated college, maybe moved back home, but need some money. And a good way, instead of just giving them money, a good way is for them to help out in your real estate business, so that not only do they learn responsibility, but also you're able to take a tax deduction for shifting that income to them as well. Okay.
All right, so this next one is just a quick fun list of some of the crazy tax court cases out there where people have challenged the IRS and actually won on some of the, crazier tax deductions you can hear about. I mean, there's actually a couple on here that are real estate investor related to, probably nobody's surprised, but I think the private plane was a real estate investor, if I remember correctly.
Yeah, so they argued that they needed a private plane to fly around to visit their rental properties. So if you're in the market for a private plane, that's certainly a strategy to consider.
Yeah, and then funny story about number 8, the girlfriend. This is a story about a landlord, property owner that was paying his girlfriend to kind of help manage his properties, and and so the IRS challenged him on it, and he actually took him to court and he won. But one time we were doing a presentation about this, and this is actually our last slide, and we were kind of running short on time, had to run off the stage, and somebody yelled, "Hey, tell me about the girlfriend." And so I just blurted out like, "Oh, he was paying her for services," and then it's like, "Oh, that's probably not totally accurate," but it didn't, it was kind of funny.
Yeah, so effectively, the IRS was like, hey, you can't take a deduction for giving money to your girlfriend, right? That's not okay. but he was able to prove that his girlfriend was helping him out in his real estate properties. And therefore, it was a legitimate business deduction. There's nothing that says you have to pay an unrelated party. You can certainly pay your girlfriend as long as it was reasonable. So he did get to take that deduction legitimately. So, so it sounds similar, right? On the previous slide, we just talked about income shifting. So this is the same exact concept, but instead of shifting income to his kids, he's shifting it to his girlfriend. And so we're seeing, this kind of strategy also works with, other family members too. If you have siblings or parents who've retired and are at lower tax brackets than you, if you're helping them out financially anyway, it might make sense to have them be, part of your business to be able to reduce taxes that way.
Yeah, this next one is kind of diving into, for those of you that are investing in rental properties, I think cost segregation and, accelerating depreciation, claiming bonus depreciation are probably one of the big value adds that you can do in terms of your tax saving opportunities. They've got, obviously if you do invest in rental properties, you kind of all know, you write off a residential property over 27.5 years, a commercial property over 39 years. But there are ways to accelerate that, I guess, or take it faster. They came back with, they had bonus depreciation years ago, but they came back with it a couple of years ago. So now if you can do a cost seg and pair that with a bonus depreciation, it's kind of supercharging your tax deductions, if you will. And we can kind of show you that with an example here.
Yeah, I think it's really powerful to go over an example. And like Matt said, this year we have a 100% bonus depreciation. So that means on some of your rental properties, if you do a cost segregation, you can write off 100% of some of the related costs. So in our example, let's say you buy a rental property for $300,000, right? And you put $60,000 down, which means the remainder is just, bank financing. And let's say that on this $300,000 property, the land was worth 50, so the building is worth 250. And the reason we break that out is because only the building can be depreciated, the land we don't depreciate. So generally speaking, if you did a cost segregation by accelerating your depreciation, along with the bonus depreciation of 100% write-off we have this year, first year depreciation on this rental could be up to $75,000 of a write-off. So you can see how with $60,000 of a down payment, your first year write-off is actually more than the money that you had put down on any given property. And so assume, let's assume you're in the 37% tax bracket, between federal and state. This might save you about $28,000 in taxes just using depreciation. So this is outside of the income shifting in the home office and the interest and the taxes. This is purely just on depreciation on how much you can potentially save. So, a couple of questions since we're kind of close to the end of the year. Bonus depreciation is available for all properties that are placed in service this year. So even if you're someone who's buying a rental towards the end of the year, a lot of times with cost segregation, you can still get a very significant write-off, even though you've only, owned it for 2 months or, 1 to 2 months period. Okay.
Yeah, the idea of cost segregation is you're going to get to take depreciation on your rental properties anyway. And like I said, you spread it out over that 27.5 or 39 years. But the idea with cost seg is how can we take more of the depreciation sooner, right? So if we can take more of the deduction sooner, we're saving taxes now. We're using that savings, we can reinvest it, buy more income producing assets and kind of keep the, the income, the wheel turning, right? In terms of building wealth and getting to that magic number where you can, retire or have the choice to work or not, right? So that's what cost segregation can really help you with from a tax savings perspective.
Yeah, if you can save, $20,000, $30,000 on taxes with one property, that could be the down payment on another property in itself, right? So it just continues to grow. So next, we want to talk about real estate professional. This is one of the main strategies for a lot of investors who own rental real estate. Okay, so this is only important if you own rental real estate. If you're just involved in flipping and wholesaling, then and don't own any rentals, probably not really a relevant strategy. But effectively, the way that it works in the tax code is if your income, single or married, if your total income is under $150,000, you can use some of your rental losses to offset other types of income. So meaning if we had a $10,000 rental loss, after writing off our home office and car and depreciation, if we created a loss, we can use some of that loss to offset taxes from other types of income, maybe from a job or interest income or capital gains from stock investments. However, if your income is over 150,000, your rental losses can no longer offset these other income. It can always offset taxes from rentals. It just doesn't also offset taxes from your other income. And so that's one of the downsides that, if you're a higher income earner, then oftentimes your losses on the rentals are limited. Now, it doesn't mean you lose them. You still get to utilize them in the future years to offset rental income. You just don't get to use that immediately to reduce taxes from your W-2 activities. Okay.
And then so the way around that is if you or your spouse can qualify as a real estate professional for tax purposes, and you're able to generate losses from your net losses from your rentals from home office income shifting, cost setting, bonus depreciation. As a real estate professional, you can use those losses to offset your W-2 income or interest, dividends, or whatever business income you have without any limitations. So if you're able to generate a $300,000 net loss just because you accelerated a bunch of depreciation, then you can use that to offset all of your other income. So it can become a powerful strategy, especially when you compare it with cost segregation, for an example.
Yeah, so a couple common main things to understand for a real estate professional. It does not mean you need to be a realtor or be licensed as a realtor or broker. This is purely a designation when it comes to taxes. So to be a real estate professional, a couple of things. First, you have to spend at least 750 hours in real estate activities, okay, at least 750. The next thing is you have to spend more time in real estate than your other income activities. So for example, if you have a part-time job, let's say you're a firefighter and you're working 1,000 hours a year, well, then you have to have more time in real estate than your job. So we need more than 1,000 hours, maybe 1,001 hours in real estate versus your regular or other W-2 activities. And then the third requirement is that you have to materially participate in your rental properties. Usually that means at least 500 of those hours needs to be on rental properties. And again, there's nothing to do with designations. We have clients who are doctors, part-time or retired doctors who also claim to be real estate professionals. We have part-time teachers who claim real estate professional. And it's one person if you're married. So you could be someone working full-time. If your spouse can qualify as real estate professional based on the hours requirement, then both of you will get the tax benefits. Okay. So I'm sure we can answer more questions on that as well during the Q&A.
Next one we just want to touch on briefly is legal entities for rentals. Now, this is a question we get a lot. I think one big takeaway we want everyone to kind of take away from this is that from a tax perspective, generally speaking, whether you own your rentals in your own individual name or you own them in some sort of pass-through entity like an LLC or a partnership, the actual net tax impact to you, the income you're going to pay taxes on, the deductions you get, how it's treated for tax purpose, all that stuff is going to be the exact same whether you own it personally or you own it through an entity. So having said that, generally speaking, when we're looking at legal entities for rentals, we're talking about doing it purely from an asset protection standpoint. Now, the other another takeaway is what we generally don't want to see is owning your rentals in a C corporation or an S corporation for tax purposes. We won't dive into all the specifics of why, but it's just, it can create tax problems and tax disadvantages down the road. So if you're going to own your properties in an entity, we'd like it to be like generally we have clients that use LLCs, right? So they're either LLCs that are disregarded or they're LLCs that are treated as partnerships for tax purposes.
Yeah, and I think the main thing just to keep in mind, again, all the strategies we've talked about so far, right? Real estate professional, income shifting, home office, maximizing write-offs, depreciation, they all work regardless of whether you own your rentals individually or through a legal entity like an LLC. Okay, so the entity itself doesn't change the tax strategies. The other thing we want to touch on this maybe a little bit more briefly, this is investing in opportunity zones. So I think some of you might be involved in that. I don't know how many people are actually doing that at this moment. But effectively, this came out under the Tax Cuts and Jobs Act a couple years ago, still valid today. This is a strategy that a lot of our clients use specifically for people who are looking to move. Maybe they're trying to move money from stocks to real estate, or maybe they've sold a business and they want to put that money into real estate and also defer the capital gains. So one of the main benefit of opportunity zone is in the past, if you wanted to, if you made a lot of money in the stock market and you want to now move it to real estate because it's more secure, it's a hard asset. In the past, you would have to pay taxes on the capital gain, and whatever's left over is what you invest in real estate. The opportunity zone, when this came out, it basically is for the first time allows you to sell your stocks and then be able to take that capital gain and invest directly into an opportunity zone fund without paying the taxes right now. So it allows you to defer the taxes on the capital gains, usually until the year 2026. So you have a couple years of tax deferral there. There's an added benefit that if you hold that ozone investment for at least 10 years, then you would get some tax-free appreciation on the property as well. So ozone is kind of a complicated beast in itself. The majority of our clients who do invest in ozones do so passively in other people's deals, like the larger syndications. I do have one client who's decided to do his own opportunity zone fund, which you can do. You can buy your own property that's located in the ozone and meet all the requirements to get the benefits. But those are, a little bit not as frequent. We don't see that as frequently as the ones who just invest in funds. But, who would this strategy ideally be good for? This might be a good strategy for you if you have capital gains taxes that you're facing, whether it's the sale of stocks, sale of real estate, even if you sold your primary home where you had to pay taxes on it, or sale of a business, okay? If you're facing those kinds of capital gains taxes, then opportunity zone might be a good strategy to consider.
Yeah, and then the next one we just want to touch on is retirement planning. So retirement planning is kind of one of our favorite topics. We've done probably half a day workshops on this before. And some of the takeaways here is that, obviously a lot of people know about the individual IRA or the individual Roth IRA that you can invest in. But I think the takeaway here is that, if you do have a side business, and when we say a side business, it's got to be something other than rental properties. So maybe you're a realtor or
wholesaling, flipping.
Yeah, flipping. Maybe you're, like I said, realtor on the side. One of those type of side businesses you can have, either a SEP IRA or even an individual solo 401k that will allow you to set aside a lot more into retirement every year, beyond the, generally the $6,000 you can do it as a traditional IRA or Roth IRA. The other thing that, some people, I know more people are aware of it now than they were 10 years ago, but a lot of people still don't know is that you can self-direct your retirement account. So you can actually open a solo 401k, depending on your income and what you make, you can put, let's say an example, you put $30,000 into it. You can then use that $30,000 in your solo K to go out and invest in a rental property. And we have a lot of clients that do that. And so they're kind of getting, killing two birds with one stone, right? They're getting the tax deduction, but then they're still getting to use that money to invest in real estate, which is what they wanted to do in the first place. So it kind of, it can be a big win-win, and just, again, more than maybe just the traditional IRA or the Roth IRA route.
Yeah, I think the only thing I would add to that, right now under the CARES Act, between now and the end of the year, if you are someone who has been negatively impacted by COVID, either financially or via diagnosis, you may be eligible for a retirement distribution. And that basically came under the CARES Act, where you could take out up to $100,000 from your retirement account as early distributions and avoid the early distribution penalty, right? So at the federal level, that's a 10% penalty. You can avoid the penalty on that. And then in addition, the distribution, usually when you take a distribution from retirement account, you have to pay taxes on that immediately in the year you take it out. But under the CARES Act, you have the ability to spread out the tax over a 3-year period. So you pay taxes on a third of that money this year, a third next year, and a third in the following year. And then the last piece of that is if you wanted to, or if later on you had additional funds, you can pay back your retirement account and file a refund of the taxes that you claimed previously. So this is a sort of a limited time option that the IRS has given us in light of COVID-19. So we don't necessarily recommend you go out and start liquidating retirement accounts. This is intended for people who actually need the money. There's no other sources of income. You really need to do it. That's certainly a benefit. But otherwise, if you don't really need the money for living expenses, like Matt said, going the self-directed route and using your retirement money directly into real estate is generally still going to be better because it continues to grow tax deferred.
Now, one of the things to keep in mind that, as Amanda mentioned, that limited time opportunity with the CARES Act and the distribution, that applies to any distributions you take. You got to take them by December 31st of this year. So obviously, we're still all going to be dealing with COVID and stuff in early next year. But as it currently stands, that early distribution opportunity only applies to distributions taken by December 31st.
So what does it all mean? Couple things. Current tax law highly favors real estate investors of all types. Which I think all of us, tonight, we all know that, right? To be fact, you've read about it, kind of just something we've accepted in our lives that tax law favors those of us in real estate. However, tax law can change at any time, especially this year, an election year. There are a lot of talks of changes to the tax law. Some are specific to real estate. And so, that's in any year or two, right? Things could change, but specifically for this year. So it's really important to make sure you work with your tax advisor and plan for ways to take advantage of the current tax breaks while they still exist. Okay. And that's it. I think that's it for the presentation part. We can go over to the Q&A if you guys, I don't really know how to do that on Zoom. So I'll hand it back to you.
Yeah, no, that's awesome. So yeah, we actually have a few in the chat box. So if you guys want, just so we don't have a bunch of people asking questions at once, if you could type them in the chat box, and we'll go ahead and ask them for you, and then we'll just kind of go from there. I'll also be checking on Facebook Live for those of you who are watching on Facebook Live as well. So I think Ajay I think that's how you pronounce it, correct? Ajay? I just want to make sure. But he actually had a question.
Yeah. Ajay is correct.
Oh, you did? Okay, I just want to make sure. Awesome. So yeah, he actually had a question about how many years can we carry the rental losses if we are making more than 150,000 in other income? So I think that's really.
Yeah, thank you. That's a great question. And it's unlimited. So there are no limits to how long you can carry the losses. You basically continue to carry it forward until you use it up. Or in the year you sell your rental property, you generally get to use all of that loss to offset the gain and offset taxes from your W-2 and other income as well. So it doesn't ever expire.
So something that comes to mind, we've seen that sometimes where, clients own a property that has been accumulating losses for X number of years. They can't qualify as a real estate professional, and the losses just keep getting carried forward. They're owning the property, maybe it's not performing as well as they want. That can be a way that you can, depending on the numbers, obviously, you could get out from that property, sell it. Maybe you've got a little bit of gain, maybe you don't have any gain, but just the fact that you can deduct those carry forward losses related to that property, that can swing your taxes dramatically, where it can, boost your, again, provide another down payment for the replacement property that you weren't anticipating,
I have a question real quick. So one of the things that I've faced in my investing career thus far is when you take deductions and you go to a bank and say, hey, I want to purchase this property. Sometimes they say, oh, well, I mean, your income doesn't justify it based on the deductions that you've taken. How exactly do you manage that? And how do you recommend your clients manage that?
Yeah, I mean, we hear that all the time. In fact, I was just talking to someone earlier today about the same thing. And, I think the key is to make sure you're working with a lender or a broker who has a lot of experience in working with investors, so they can explain to their underwriter what all these deductions mean. Because there are a couple deductions just off the top of my head that a lot of lenders, once they understand it, they'll make adjustments for, right? So some of the common ones we talked about today, depreciation, bonus depreciation, accelerated cost segregation. So to explain to the lender, those are not actual cash that we've spent. Those are simply tax write-offs. So a lot of times they'll add back the depreciation. A home office is another one, right? So lenders should understand, I have a home, I have mortgage, I have taxes, I have utilities, regardless of whether I claim it or not. So this is not an added cost. So, and I'll same with car, right? Car expenses, we all have them. It's just whether you write it off or not. So those are the three major ones. Some other ones I think that we see sometimes is retirement contributions, right? So some lenders I've seen, they'll say, okay, that's discretionary. I'm not going to count that against you because I understand you can choose to fund or not to fund. So that's not a, a true recurring expense. And, sometimes the repairs, you can let them know those are one-time repairs and not recurring. I think the main ones they will always consider, insurance, interest, property tax, and any management fees. Those are the ones that, sort of can't really explain away because you're always going to have those.
Definitely. Awesome. So Ben Elliott, hey Ben, is it possible to move a property from a personal name to an LLC while doing a 1031 exchange?
Good question. So is it possible? Maybe. Is it recommended? Probably not. So meaning you can, when you do a 1031 exchange, Ben, you may have even come across this, which prompted the question is, when you're selling your old property, we'll call it the old property, relinquished property, one of the rules is that however you're holding title to that property is has to be the same taxpayer that holds title to the replacement property. So if you own the old property in your personal name, you got to buy the replacement property in your personal name or vice versa. Now, having said that, once you close on the exchange, there's nothing to prevent you from transferring it to an LLC that you own 100% of that's a disregarded entity. So we've seen people do that very shortly thereafter closing the exchange. The thing you want to watch out for though is if you're trying to move it, from a personal name to an LLC that's maybe owned by a husband and wife that's treated as a partnership. Obviously you and I all know that at the end of the day, that's all owned by the same family. But for tax purposes, you versus a partnership that's owned by a husband and wife are considered two separate taxpayers. And if you do that too soon after a 1031 exchange, the IRS can actually come in and kind of, I guess, undo the exchange if they really wanted to.
But if I do that, would the bank still be able to call a loan on the new property?
Mm-hmm. So that's a separate question, right? Outside of the 1031.
Right.
I mean, then the separate question is, okay, if I move it to an LLC, will they call the note due? I believe that is in every loan agreement that they have the right to do it. And it's designed so that you don't just move it to an LLC owned by me and they don't want to lend to me. So that's not necessarily a tax thing. I think I would just talk with your attorney on that. I know a lot of attorneys recommend using a land trust or title holding trust in between, so that the lender is not, don't easily see that title has been transferred. And again, if the LLC is a disregarded entity, which means you own 100% of it, they don't really see that on the tax return because it's still going to be reported on your personal tax return anyway. So the tax side doesn't alert the lender to that fact at all.
Okay, thank you.
Yeah, thanks, Ben.
Hey, Luke, you're going to ask the next one?
Yeah, I got this one. Hey, so we had a question over here. AJ again had a question about capital gains. He said one of the slides showed 0 to 80K was 0% tax paid. But if we sell a rental property, say 30K after a 2-year hold, do we not pay any capital gains tax on that 30K because it wasn't up to 80K?
Yeah, actually, so what this is referring to is not necessarily the amount of the capital gains. It's actually referring to what is the income bracket that you're in without the capital gains. So if you happen to be, in this example, married, if you happen to be in that $0 to $80,000 range and of everything else, W-2, interest, dividends, everything else, and then you had this $30,000 capital gain, some or all of your $30,000 capital gain may be taxed at 0%. But it's not as easy as just saying, okay, my capital gains is under 80 grand and therefore it falls in these ranges. It has to do with your other income, and it's and there are some calculations involved. But that's generally what it's saying.
Yeah, got it. Thank you very much.
Yeah, and it's a great, I mean, it's a powerful strategy. We have clients who decide to sell real estate when they have a low income year, in which they just end up paying 0% capital gains by design too. So
Good info. Good to know for sure. And then Nick has another question for us. Nick says, previous CPA set up his S Corp and the new CPA he's using said that he should be taxed as a partnership, doing a large cash out refi. And I lost it. I lost my chat box. All right, now I got it back. But he needs the partnership first. So is there a way he could change in his incorporated status to a partnership and not take a tax hit on it?
Yeah, there are a couple assumptions here. So if the entity itself was set up legally as an LLC and then elected to be taxed as an S Corp, there's a way to keep that entity and go to partnership status. And I'll come back to that. But if it was set up legally as a corporation, treated as an S Corp, you can't have a corporation go to a partnership. So you'd have to have two separate entities in that example. Now, from a tax perspective, if you've got the existing entity, you're going to just change from an S Corp to a partnership because it's like an LLC. Not taking a big tax hit is going to kind of depend on the numbers. And the reason being is that when you go away from S Corp tax status to flow through partnership tax status, they can tax you on the deemed depreciation of the underlying assets as if you sold them to yourself, essentially. So the only way that you're not going to get a big tax hit in that situation is if you can justify that the value of the properties are very close to what you paid for them originally. Going to your question, obviously you're doing a large cash out refi. That would imply that that's not the situation, obviously. Just because you've got some appreciation in your equity you're cashing out there. So
yeah, I guess that I think this is more maybe a lender question is, why does it need to be a partnership in order for you to refinance, right? Because otherwise, if you can, if let's assume that these properties in your S Corp are highly appreciated, what you paid for versus what's worth today, oftentimes it makes sense just to leave it in there rather than taking that huge tax hit by moving it out or by moving that S Corp into a partnership. So you can see, earlier we said, okay, when we don't recommend rentals in S Corps. This is the exact reason. This is one of the exact reasons why we say that, because had this property already been in an LLC to begin with, you can always move it in and out of an LLC for refi purposes or whatever reason you need to. There's no tax issues. But this issue does exist when it was held by an S corporation. So it's kind of I would say try to see if you can refi an S corp first, if the tax hit is going to be pretty big as the other alternative.
Okay, I think that's a good point there. We have the next one from Satya. Can we buy property as a partner agreement with two owners, or does this have any disadvantage compared to an LLC?
Yeah, so you can, I think generally they're probably referring to as you're buying as just tenants in common, right? So you own a percentage of the property, somebody else owns it in their name as a percentage of the property. From a tax perspective, you would just end up reporting your share of the property on your Schedule E, and they report their share of the property, the income and expenses on their Schedule E. Any disadvantage compared to an LLC? I mean, it's easier because you don't have an LLC, you don't have a partnership, you don't have to file an extra tax return. The downside that I think people run into is that, as an example, you go into it as 50-50, but maybe there's more money that's needed as you move along and each person's not putting in 50-50. Maybe somebody puts in 60%, somebody puts in 40%. Technically speaking, for tax purposes, you're supposed to deduct income and expenses based on your ownership percentage and not necessarily what you did with the money. So that can muddy the waters a little bit in the future using an agreement like that versus an LLC. I don't know. Did you think of anything else?
Yeah, I think, and also I would run this by your attorney, of course, right? If you just have a general partnership agreement, my understanding is that it is exposed to liability. So meaning if your partner does something bad, they could theoretically get into this asset that maybe you're part owner in. So from that perspective, might be more advantageous to have it in an LLC just for liability purposes. But I would check with your attorney on that one for sure.
Awesome. That's great advice. So Ben, hey Ben, he has another question related to owner-occupied fourplexes, which I actually have one too, so it was awesome. So for an owner-occupied fourplex, what would be the capital gain tax? What would a capital gain tax look like for that if you were to sell?
So Ben, assuming you held it for more than a year, you'd be either looking at, from at a federal level, probably 15% most likely, or 20%. Just to, if you happen to be in one of the higher regular income tax brackets that we were showing on that screen earlier, is if you're in the kind of 400,000 or more of overall income, then your gain might be taxed at 20%. But if you've held it less than a year and you sell it, even though it's a rental property, it's capital gains, it's just going to be taxed at whatever your marginal tax bracket is for that year. So there's no special tax rate in that situation. And then some states, California is not one of them, but some states may go along with a preferential capital gains rate, but like California, they just tax you whatever your marginal rate is for your capital gains. So
yeah, for the owner occupied unit, if you assuming that you've lived there as your primary home for at least 2 years, then you should get part of that excluded under the primary home gain exclusion. So which is 250 individual, 500 for married. So yeah, basically it's going to be prorated, right? So 1/4 of that would be your home. You get part of that excluded, and then 3/4 of that would just be, like Matt said, long-term versus short-term. Okay. Thanks, Ben.
Yeah, that was a great question. So we have Philip actually. Hey, Philip, he had a question related to a disregard entity. Can you kind of explain a little bit more about what that actually means?
Yeah, good question. So we should start throwing out tax jargon, right? So so when you're an LLC, generally you have two ways you would pay taxes. One is as a partnership, which just means it's owned by more than one person. The other is it's a disregarded entity. Disregarded entity just means that it does not file a separate federal tax return. So if I say I have a rental held in my LLC that's owned 100% by me, that's really just me. So it's disregarded for tax purposes, and we would just report that directly on a personal tax return. So disregarded entity just means that there's no separate federal return that's filed, and it just goes directly, the income or losses just goes directly on the owner's tax return.
And in disregarded entity, meaning one owner, so it can be a single person, or it can be, if you happen to live in a community property state, it can still be spouse and spouse. That for tax purposes is considered one person. So if you happen to live in a community property state, your LLC can be disregarded and not have to file separate returns. But if it's two spouses living in a non-community property state, you would have to file you're treated as two separate people and then have to file a partnership tax return.
Okay. I have a question myself next, and I was afraid to ask this a little bit because I don't want to sound like an idiot, but in risk of sounding like an idiot, I'm going to ask it anyways. So I heard of this thing the other day where I think it's either your primary residence or a second home that you can rent it out up to 14 days during the year and not pay tax on what you rent it out as at the rate or whatever. And you can go around and shop and see how much it would cost you to get a conference room at like a hotel or somewhere close for you to rent for your business to have your monthly meeting, right? And so this guy was saying you could basically, if the amount that it would be reasonable equals your mortgage payment on your home and your taxes and insurance and whatnot, you could theoretically write that off for your monthly meeting 12 times a year and not pay taxes on it. Is that something that you've actually seen in practice people do? I've never seen it. I've never talked to anybody. I've heard about it, and it's something that when I ask people about it, most of the times they're like, no, that doesn't sound like something you could do. My accountant didn't know.
Yeah, so no, it is certainly something that you can do. We don't have a lot of clients who utilize that strategy, and the main reason for that is typically that works when you have different entities. So it's one thing to say Luke is renting from Luke, right? That doesn't sound so kosher. But if Luke has an S corp that is a flip business, for example, and you have employees in that business, and we say, hey, employees, come to my house for our quarterly meeting. And so we have less than 14 days rental. Sure, that would make sense, because otherwise I would have to take my employees to a conference room in the hotel, but no, we're all here. So it kind of just depends. Again, if it's just Luke owns some properties and there's not really a business purpose to say, well, I'm renting for myself at my meeting with myself. But if you have another business, you have other people, then that kind of legitimizes that strategy more. So yes, we do have clients who use it, but usually it's the ones that have another company, that have employees, and they have a nice house where they're actually using that for that purpose.
Okay, perfect. That is a really good explanation. That clears my, because I've been confused about it since I heard about it. I was like, is that? But it makes sense what you're saying. You can't just rent your house from you for you.
Well, I think another real life practical example we see that used is like that what you're referring to is sometimes called like the Masters rule, because so if you do like the Masters golf tournament in Georgia, right? Some people will rent out their house for 13 or 14 days because people are coming for the tournament. In those situations, they don't have to report the income because they rented their house out for 14 days or less for the year.
Yep.
So you'll see that like, one-off events like that, or like, out here in Southern California, you have, we used to have musical, concerts and events where they, it's like a five day, thing where people go out to the desert. So you'll see that a lot where people rent their houses out for only, a week, and they don't have to report the income.
Yep.
And so for us here in Louisville, those of you in Louisville, it's the Derby. You can rent your house out for Derby. I actually did that last year, and then you don't have to rent.
No, so I mean, that's, and if you do that, then it's basically, 14 days of free money, or tax-free money, I guess.
Yeah. Okay, cool.
The city's collecting transient tax, or they're trying to collect transient tax now on that. I know they were working with like Airbnb to get a list of people who did it, because if you list it on Airbnb, they have the filing of everything. So
yeah, so that 14-day applies to federal taxes. I don't think you can pull that out with the city of Louisville. And
no, you still have to pay your transient tax, but luckily if you book through Airbnb actually charges the guest that tax up front, and you don't have to take it out of your pocketbook. We have one more question here that I've got in the chat here. Says Nellie says this, she transferred property into our LLC, but the mortgage remains in personal name. The property is managed by a third-party manager. Should we pay the mortgage directly from an LLC checking account, or take a monthly draw and pay from a personal checking account?
Good question. So tax-wise, it doesn't make a difference. The interest is going to be deducted against the rental property, regardless of where you pay it from. But I would imagine, again, the only reason you have the LLC for your rental is for asset protection purposes. So I would imagine your attorney will likely want you to pay for that with LLC funds. So with the rental income that's in the LLC, use that to pay for the interest. Or if the LLC doesn't have enough money, then personally put money into the LLC so that the LLC can pay for the interest.
Okay. All right. We have time for one more question. Oh, I think Jay had the question. So do we report insurance claims as income? If the expense is $4,000 paid out of pocket and insurance pays us okay, so wait, sorry, it was hard for me to read. Do we report insurance claims as income? If the expense is $4,000 paid out of pocket and insurance pays us, let's say $2,000.
Yeah, and the simple answer in that example is you're gonna end up deducting a net of $2,000. So whether you're doing $4,000 expense, $2,000 income, at the end of the day, you've lost $2,000. So that's your expense. There's times when it's way more complicated than that, but that's kind of the simple answer. So yeah, I mean, in short, you have to report the insurance money as income. It's just a matter of how and where.
Yeah, you claim the 4,000 expenses that you incurred having to repair.
One final question. I know John, he asked it, so I wanted to get it in there before the end. So, okay, last question. John Sherwood, he asks, income shifting, is income shifting to offset rental income, or can you offset W-2 income in some way? And that's, I think, what you referenced related to real estate professionals. Is that correct?
Exactly. So income shifting, the expense of paying your kids or family members, that's the same as any other write-off. And so you can use that to offset, you can always use it to offset rental income, assuming you're paying your family members to help with rentals, right? To use that to offset W-2 and other income, it would be, if your combined income is under 150,000 usually, then you can use that. Or if you or your spouse is claiming real estate professional status, then you can use that to offset all types of income. Just a real quick note, income shifting is not limited to rental real estate. So for those of you who are also doing wholesaling, flipping, I don't know, you have a tech business on the side, realtor business, income shifting works in all types of business because your kids can help out in any capacity, right? As long as it's reasonable for the tasks that they're doing.
But they did take away a couple of years ago, they took away the unreimbursed employee business expense category. So if you were working as a W-2 for somebody and saying that, you were kind of farming out some of your work to your family members, maybe a couple of years ago, you might have been able to make that work, but unfortunately it doesn't work like that anymore.
Yeah, so just use it for rentals in your own business.
Awesome. Well, I think that was the last of it. So with related to income shifting, it's you just issue a 1099 to the child.
A good question. So our options are 1099, 1099 or W-2, right? And so usually I would say it kind of depends on what your kid's doing for you. For younger kids, usually it's going to be W-2 stuff because it's going to be recurring, kind of repetitive work. And it's difficult to argue that your 8-year-old is your consultant, marketing consultant or IT consultant, versus the old, when they're older and they're more project-based, like, hey, I hired my son to help me put a social media marketing campaign. Those can argue to be more like a 1099 issuance. So it's going to depend on the task, whether it's project-based or more on a recurring basis.
Awesome. Well, thanks so much, guys. It's right around 7 p.m.
7 a.m.
Right. Almost there, 12 hours away. But really just want to thank you for your time. You guys have been super gracious with your time so far. And if you guys haven't had a chance to check out the book, it's definitely worth it. I read their first book. I haven't read the Advanced Tax Strategy book yet, but I'll probably pick that up at some point and take a look at it and drop you guys a review as well. Luke, do you have anything else you'd like to say before we?
Yeah, I just want to say thanks so much. I know taxes is always a topic that the more you talk about it, the more you learn and the more you understand it. And it's been a learning process for me over the years. So I really appreciate you guys taking the time and answering my stupid question as well. But I understand it now.
Yeah, thanks for having us. It's fun to be here.
Yeah, I appreciate it, guys. Thanks a lot.
Yeah. And this will be recorded as well. So if you guys are watching this on YouTube, definitely, check it out. So
That's good.
thanks guys.
All right.
Bye,
Thanks.
everyone.
Have a good one.
See you guys.
Thank you, Raphael and Amanda and Matt. Thank you guys so much.
Oh, of course. Yeah. Thanks, guys. Thanks for tuning in. And we'll see you guys soon.